Hello, Oracles! Oracle Tim here from Oracle Investments. What another great green day today. Tesla up 2.5%, was over 1100 for quite a bit today. You know, I happen to put out my bull case price targets for the next 10 years and Tesla continues to go bull on the day. I love it. Will we hit my bull case price target for the end of the week of 1125? Totally looks like we might. I'm not sure. Will we continue this rally? I think we might. I do still think that we're going to see a little bit of a sell-off after the beginning of the year, but I also do think we're going to see a nice euphoric run up into Q4 earnings. So it looks like some people on Twitter were believing that perhaps Elon was selling today, looking at the way the stock was going up and then spiking back down a little bit before it went back up again, and then finishing under $1,100. It's totally possible. We will find out later tonight, and I will report on that in the morning if that is what happened. But today I want to talk about cash flow strategies and retirement. So obviously all of us want to retire at some point, and retirement is different for everyone. Retirement can be living on a beach sipping drinks all day long. Retirement can be just continuing doing the work that you love because you love to do it. So it's totally different for everyone, but what it comes down to is having that financial freedom to be able to do that. And how do you get that financial freedom? Well, there are many investors out there, many of you who are subscribed to this channel, who are going to retire on Tesla. You're either all in or nearly all in on Tesla. Some of you are already Teslaonaires, and some of you are working your way up to it, and that is your retirement strategy. I personally think that is totally awesome, and I admire you all for that. I'm not at that point, and I am very conservative, so while I do have almost 50% of my portfolio in Tesla stock, I do still like to diversify. And all of my diversification strategies all revolve around cash flow generation. What are the different ways that I can generate cash flow? Where in the future, maybe I don't want to sell my Tesla stock. Maybe we get to the point in 10 years where I'm retired and I say, you know what, I can sell Tesla, but they just came out with the AI bot that is now putting them at the bottom of another S-curve. Well, maybe I want to buy more at that point. And if I do, if I have the cash flow coming in that allows me to live my life the way I want, I can then invest more in Tesla and then pass that generational wealth onto my son and my future generations. And I have seen many bull case scenarios out there where in 10 years, if you invest a lot in Tesla stock now, you're going to have plenty of generational wealth out there. And I totally believe some of that can happen. Tesla has so many amazing things in the works for them right now that, you know, they're getting into innovation spaces that don't even exist. So much promise and for them in the future, you know, that it can totally happen. And you won't even need any of these other cash flow generation means. But that is not a way I play it currently. So if you're in the same boat as I am, maybe you are a little more conservative and you want some other cash flow generation options, we're going to go over one today that I discussed a little bit last week, but I really want to go a little bit more in depth into one specific dividend fund. And I'm only going to discuss the way I'm using it right now because I want to speak from experience on this. And so my Roth IRA that I have is where I put all of my dividend stocks and my dividend funds. Because in there, you don't pay taxes on the dividends. Those dividends get rolled into your current funds that you're in, and you just keep on building those up, which will make it grow even faster. You can put $6,000 as a single individual into an IRA every single year. The way I put funds into my Roth IRA is on a weekly basis. I have an automatic withdrawal come out and deposits into it. It is currently $50, but I will be increasing that to $115 because at $115, that's what's going to max you out at $6,000 at the end of the year. And one of the ones that I began putting money into last week is QYLD. Now this one here is a covered call options ETF for the NASDAQ 100. Now I do not know enough about options right now to play them myself, but I can do that through an ETF with people who do know how to do those options. And an ETF, and with the dividends that they're giving out of near 12% on an annual basis, for a year you put $1,000 into your IRA and you're going to get almost $120 in return over the course of the year. And while it's true that this ETF is not a growth ETF, it is going to trade sideways because that's not how it works when you play with the covered calls. They make their calls the beginning of the month, they ride out the entire month, and whether they're up or down at the end of the month will determine what they have gotten. So usually this ETF is playing off of the premiums that they get from playing those options. And so they're generating right now about 22 cents a month per share for everyone that you've got, which again, as I said, is 12% annually. Their expense ratio is a 0.6%, which is on the low end. So, it's a below average risk and above average returns. So it's a safe one to be in. Now, if you compare that to like a high yield dividend fund for Vanguard, they're at a 0.05 expense ratio, but they only have an annual return of 2.8%. So very safe, but very slow growing, and you're not going to get a lot in return for it. And the stocks that they have in this fund, the ones that they are using their options for, are the high-end growth stocks: Microsoft, Apple, Tesla, Nvidia. These stocks here are going to be high-end growth, so they're good, safe stocks to be in, but those are the ones that they're playing their options on, because a lot of times when these stocks trade sideways, that's when you can make the most money from options. And now QYLD has been around since 2013, so they're pretty experienced, almost 10 years out there, and they've shown growth every single year and consistent returns. Now, it has been a bull market that entire time, but in a bull market, they actually don't do as well as they would in a sideways trading or a bear market compared to the rest of everything else. So if you're looking at the indices and you compare QYLD to, the QQQ, you're looking at the fact that, the returns weren't as good, but they were still outstanding returns. So now you ask yourself, do you think going forward we're going to be in a bull market for another 10 years? Or do you think we're going to trade sideways for a while? Or do you think we're going to hit this recession that some people are talking about and maybe trade in a bear market or sideways after that as well? And that, of course, is a question only you can answer as to what you believe will happen in the future. All I know is that when the returns are going to be less in a bull market compared to other indices, what's going to happen when it's trading sideways? Trading sideways, you're going to get even better returns compared to the rest of the market. So I'm going to put my money into that one right now. Not all of it, but a good chunk of it, because a 12% return is pretty significant. And also, again, these funds are strictly in my IRA and my HSA accounts. So my regular portfolio does not have any of this. That's where I have all my other stocks that are going to be higher growth. So now some of the benefits that I see from having a dividend fund such as QYLD is you will have tax-free returns with your dividends, because you're not going to be paying taxes on them through your Roth IRA. Another benefit is you won't need to sell your Tesla stock later if you don't want to, because you have this cash flow coming in that you can use for your own expenses and even buy more Tesla stock if you want to. And now you can always play the Thanos method and use your Tesla stock to buy the Tesla stock by putting yourself into margin against the stock you own, but that's not a game that I want to play. You can also use your HSA account, if you have one, to invest it there as well. And you can put $3,600 a year into an HSA, so that's even more money that can keep generating more money. And another great benefit about your HSA is it's tax deductible. So at the end of the year, whatever contributions you have put in there will lower your income come tax season. So you'll actually pay less in taxes because of this. And because you have the money in there, you're going to have tax-free dividends coming back to you. It's a win-win in that situation. And it's a passive income stream. So you don't need to actively do anything other than own the dividend stocks or the funds to be able to receive this cash flow coming in. So you don't need to sell a stock like a Tesla to get that. And in return, you don't need to pay capital gains taxes on it because it's a dividend that is coming back to you. And in the Roth IRA, those taxes were paid up front, so you don't have to pay them in the end. And some of the downsides that I see to this are, in a bull market, your returns will not be as great as many other stock options out there, like a Tesla. If you're all in on Tesla stock, you will most likely see much better returns than you will from QYLD. However, you will also have to pay capital gains taxes on any Tesla stock that you sell or any other stock or fund that you decide to sell to get your retirement funds later. Another risk that I do see is they have only been around for 9 years. They have not actually functioned through a recession. We had a little bit of a bear market in 2018, had a nice little dip that we saw obviously with COVID, but other than that, haven't seen an actual recession. Hopefully we don't even have to see one and see what it would trade like through that, but because they haven't yet, I don't know how it would trade. Despite the fact that it looks good on paper that it would do well, we shall see what actually happens if we get to that point. And the other downside is you're limited to where you can put it to keep it that tax-free. Again, IRAs up to $6,000 a year, HSA $3,600 a year. So again, for me, I love diversification with cash flow. I truly admire and love all of you guys who are all in on Tesla stock. Think it's amazing. And in the long run, you guys may do way better than I do. It's just not the way I'm built. I just want that diversification with cash flow, with dividends, with real estate, with my stocks. You know, that's just the way I operate. And if you out there are the same as me, then some of these options might be able to help you guys out as well. And if Tesla stock does as well as we do think it's going to do, then perhaps those of you who are all in on Tesla will save a little bit of room on your helipad on your yacht so I can land my helicopter. Let me know in the comments below, which is the way you operate? Are you an all-in on Tesla stock and you're going to retire on that strategy? Or would you like diversification and go through dividends and some other means of cash flow? Everyone's different. There is no wrong answer. And honestly, I think you're going to win either way. Thank you so much for watching. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am on Twitter for all the up-to-date information I can get out to you guys. It's OracleTim1. I will check later tonight for any Form 4 filings that may come out and report to you guys in the morning. Otherwise, have a great one. I will see you later.